Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. New York coffee. Now, my apologies for some of the labels appearing in light green on my daily chart. My charting system occasionally decides to throw a tantrum, and this is one of those occasions. Late last year, a few bullish patterns started to emerge that eventually led to a move up towards the combined resistance in mid-December last year of the November 2014 high at 201.35 and the 50% Fibonacci line of February 2022 to January 2023 move at 201.70. Plus, I suppose you could also throw in the declining neckline, currently at 199.90, of the April to May 2022 reverse head and shoulders pattern. Between them all, the market's rise was halted and turned back down through the late October 2023, early February 2024 imperfect and now broken bull channel. The market eventually stopped down at a combination of the congestion around the 50% Fibonacci line, the May 2019 to February 2022 move at 174 even, and the August 2021 low at 174.5, all done by the middle of January. During late January and again in mid-February, prices moved up again over the congestion between 187.40 and 187 even, but not really stabilizing over this congestion, with returns lower back towards and below the 2016 high at 179.55, and all the way down to test the important 50% Fibonacci line of the June 2020 to February 2022 move at 177.45, which has the rising medium moving average highlighted in mauve, currently at 184.80, initially acting as a backup and more recently as a support on its own. All this action allowed me to draw a December 2023 to February 2024 bearish Andrews pitchfork, which was further finessed to a mildly bearish shift pitchfork. Last week the market broke up over the upper time, as currently at 187.10, and I am now considering whether to retire this pitchfork completely. 2 weeks ago I said the following, and I quote, "I would on balance just like you to watch a few things that might indicate some further moves, might be in the offing. Firstly, there's that previously mentioned rising medium moving average support. As I said 3 weeks ago, so that is actually now 5 weeks ago, as I said 3 weeks ago about this moving average, and I quote, this may temper any bearishness and is one to watch for the next few weeks, end of all quotes. What is interesting is that from this medium moving average that the market summoned up the ammunition, evident from the wide sideways movement between approximately December last year until 2 weeks ago to break higher, through the neckline, through the 50% Fibonacci line at 201.70 and the April 2023 high at 204.90 and up as far as just short of the October 2022 high at 216.25. From this we can learn that possibly, just possibly, the October 2023 to date action could be seen as one leg, then a wide hesitation, halfway hesitation, and we are now on to possibly the second leg. Question is now, how far up are the opportunities for such a pattern? I would suggest if we do go down this route, then the 219, the 219 area would be the first possibility, with further opportunities up as far as 228 to 230 area. Now, I'm not setting any potential targets as yet, purely because the break higher has not been it's been so new, and I would like to see at least another week's worth of data to clarify my thoughts topside. London coffee. During the process of the market breaking higher from back in December last year, prices started to stabilize for a while right on a 50% projected Fibonacci line at 30.84. However, though this 50% projected Fibonacci line support did not last, it did start a process of stabilization that ended up with a late January 2023 to early March 2024 bullish halfway hesitation pattern between roughly the lesser Fibonacci congestion at 30.16 to 30.18 up to the January 2024 high at 32.61. As all this was happening 6 weeks ago, we had the short medium moving average currently at 32.50, 50, highlighted in green on my daily chart, entered the frame and turned prices higher. In the process of making this halfway hesitation, the late January to early March action also became a small bear channel, come declining expanding wedge pattern, which I've highlighted in dark blue on my daily chart. I personally favour it as a wide bear channel. Now 5 weeks ago, in the middle of the week, prices shot up through the upper bear channel line and stabilised over it. And taking its time, the market started to exploit the upside. As I said 2 weeks ago, and I quote, "It nevertheless still lays out all sorts of possibilities topside." Thus, if we look at the bear channel as a bullish halfway hesitation, then we need to look at 2 points for where to start measuring from. The first is the January low at 27.44, and the second is from the mid-December 2023 start of the rally in the 25.20 area. Thus, for the first pattern, we would have a potential target X in the 34.80 area, whilst from the second origin, we could see up as far as potentially target X1 in the 3700 area, well up off the top of my daily chart. And that's the end of the quote. A few days after my commentary, target X at 34.80 was reached, and last week the harder to reach target X1 not only appeared on my daily chart, but was achieved. All this action allowed me to draw a new pattern, the bright red late November 2023 to late February 2024 bullish Andrews pitchfork. Now the market seems to fit well within this pitchfork, but it hasn't really done much to verify it other than to see it exist. We are right now just over the middle time, currently at 36.52. I'll suggest paying close attention to this pitchfork going forward. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.